Hi, I'm Manish Dhawan with my good friend Puneet Khurana. We run a blog by the name of stoicinvesting.com. This is our podcast series. Life is too short to learn from just your own experiences. To inculcate vicarious learning, we will be interviewing and profiling interesting people from different walks of life. Hopefully, this endeavor will shorten the learning curve for our audience. Our guest today is an industry veteran with 40 years experience. He has done some pioneer work in the world of momentum investing research. In fact, in the year 2012, his research paper won the first prize in prestigious Wagner Awards for advances in active investment management. He introduced to the world the concept of dual momentum, which combines the relative strength price momentum with trend following absolute momentum. He managed hedge funds in the 1980s, working with some of the best traders in the world like Paul Tudor Jones, Louis Bacon, Monroe Trout, and John Henry. Ladies and gentlemen, I present to you the author of book Dual Momentum, Mr. Gary Antonacci.
Welcome, Gary, or I should say, Swagatam. I'm really wishing, since you're so well with Hindi, Namaskar. It's a pleasure to have you with us. Manish and I have been looking forward for this conversation. Really welcome you a lot.
Namaskar, Punichi.
Namaste, Gary ji. How are you?
Namaskar, Gary ji.
Thank you. It's good to be here.
Yeah, it's our pleasure. So, Gary, let's start from the very start. How, from being a Vietnam vet to a comedy magician to time in India, and then to trend following and momentum investing. Take us through your journey. It sounds very fascinating.
Well, when I was young, I did a lot of different things, as you mentioned. After I graduated from university, I became a stockbroker with Merrill Lynch, and I was always looking for unusual, underexploited opportunities, so I focused in on stock options at the time. This was in the mid-1970s, and gold stocks, and worked with some hedge funds, and decided I wanted to be more involved with research and portfolio management. So I went on and got my MBA degree from Harvard Business School, started managing money part-time, my fellow students, their families, even one of my professors, and I've never had to get a job after that. I've always managed money or done research. And in the 1980s, I started some commodity pools that were very successful using portfolio theory principles and some of the best traders in the world, like Paul Tudor Jones,
Right.
Richard Dennis, Louis Bacon, Monroe Trout, John Henry, and was able to semi-retire after 10 years. A brokerage firm bought out my business. So then I did a few other things that I enjoyed doing, like comedy magic, and always kept my foot in the door in terms of investments,
Right.
and followed what was going on. And about 7 or 8 years ago, I decided to research everything that was out there in terms of published research having to do with momentum.
Right.
And after surveying the entire field, I saw that there was tremendous opportunity there, but that it was not being exploited very well. So that's when I decided to do some of my own research.
Right. So from the very starting, when you started with the funds, were you focused on momentum investing, or did you, have your fair share of experiments with value investing and other kind of, investing areas, investing philosophies?
I looked at everything, basically. I looked at value, and I didn't care for the high volatility there.
Right.
And I looked for long, short type opportunities. I basically wanted to find something that provided less volatility, less bear market exposure, especially as I've gotten on in the years. So that's what got me more interested in momentum, because I could see some opportunities there. not just from relative strength momentum, but if you trend following is a type of momentum as well. And by using a trend following overlay, you could reduce your downside exposure considerably.
Gary, can you take us through a bit of experience with some of the prominent investors you have worked with, and also in your initial phase of your career or your investing career, so to speak, who are the mentors you learned tremendously from, and who probably had a large impact on your investing style?
Well, back in the 1970s, I tried to follow what was being done on a risk management side.
Right.
So I explored, all various technical and tactical asset allocation programs, and that's what moved me in the direction of commodities and futures trading.
Right.
Because I figured if you could manage the risk, then the returns could take care of themselves,
Right.
providing you had some intelligent portfolio principles in place. So I would say, my first mentors were some of the books out there that talked about trend following methods.
Right.
Richard Donchin was an early pioneer.
Right.
Ed Sekoda,
Right.
who gave a strong endorsement for my book. He was an early pioneer in this type of trading. And there were many others that I can even skip my mind now. Justin
Right.
Amos was one. He wrote some books. Nick Darvis wrote a book which was actually a form of momentum trading.
Okay.
Called "How I Made $2 million in the stock market,"
Yeah,
and that
I've
was
read that.
rotational relative strength.
Right.
And then when I actually got into the business myself and became a commodity pool operator, I was really inspired by people like Paul Tudor Jones, because I could sit and watch him trade
Right.
and actually see how the markets were not efficient like we were taught in business school, that there were people out there, not very many,
Right.
but there were people out there who did have an edge
Right.
and could earn abnormal returns. So watching people like Louis Bacon and Paul Tudor Jones and John Henry was an education. Also watching some of the bad traders. Too.
Right. Right.
I did due diligence on everyone, and one of the initially, before I became a commodity pool operator myself, I worked with someone who was a fundamentally based commodities trader,
Right.
and he could be right, but it could take him, years to be right, and meanwhile, the markets could move strongly against him. So
Right.
that impressed upon me again the importance of risk management.
But Gary, do you think that the way fundamental people behave when it comes to commodities, where leverage also come into picture, and way people behave while they're investing in stocks, do you think the results vary dramatically, and that is why one way of strategy works when it comes to stocks, but not in commodities? Or do you think momentum has an edge no matter what kind of asset class you're investing in?
It depends what you mean by momentum. Momentum is relative strength.
Right.
Certainly has an edge everywhere. My blog post I put out yesterday shows that just using relative strength momentum, you can do so much better than just passive type of investing. But in terms of risk management, also trend following, I use absolute momentum for that, but trend following can give you an advantage pretty much everything you do as well. And the two are closer together than you think, because even though you think of commodities as having high leverage and being risky, and so fundamental analysis might not be so good there, when you look at how people actually invest in stocks, if you look at the Dalbar studies, it shows that people become emotionally caught up in their investments. They get swayed by fear and greed, and they sell when they should be buying and buy when they should be selling. So even there, if you just go off of fundamentals, you can end up severely affecting your returns in an adverse fashion. I believe the last Dalbar figure showed that people underperformed just the S&P 500 index by 45% a year just because they made poor timing decisions in their mutual fund investments.
Yeah, that's interesting because the moment you said that, I reminded of my conversation with Wesley Gray, and he has also written a foreword to your book. And so the basic idea is not value or momentum, as per him. The idea is to remove the biases when it comes to investing, either fundamentally or momentum. And that is why I think that the major idea is that move towards more systematic trading or systematic investing than bringing any kind of discretion into the decision making. Is that a right way of looking at it, rather than separating between fundamental and momentum way of investing?
Well, there's two aspects of that. What Wes was speaking about is having a systematic rules-based approach to the markets. And that's very good, of course, because that does take your emotion out of the decision-making process. And studies have shown, meta-studies, looked at many different studies, have shown that models outperform experts. Models even outperform experts who are using models. But there's another thing that we're talking about here too, and that has to do with individual investor behavior. And even when you have models, like you can have a quantitative model that will pick stocks for you and based on valuation. You can have one that will pick stocks for you based on momentum, but you still have to deal with the swings in the market. And sometimes, like with value investing or stock momentum investing, those swings can be larger than you would get from the market itself, from the broad-based market indices. So to my way of thinking, you need something to deal with that as well. And that's where some type of trend following overlay comes into play. Even if you were to get a somewhat lower return, it would be worth it just to keep your emotions out of the equation. And in fact, if you do it properly, you don't have to receive a lower return. You can actually get a higher return. What happens is you don't have to make up these horrendous bear market losses. If your stocks drop 50%, you need 100% gain just to get back to break even. So if you can avoid those severe market drawdowns, you can pick up right where you left off when the markets start going back up again.
True. In fact, I was going through one of your back tests, and it's not per se the relative momentum, but the absolute momentum is the one which actually saves your backside, doesn't it? That is the one which protects you from the drawdown.
That's correct. That protects you from the drawdown, but they both complement each other and they both enhance return.
Definitely.
If you go through some of my blog posts, my recent blog posts, you can see that either one by themselves is not nearly as good as the two together. There's a synergy that takes effect in having the two.
So let's talk about that. Now, I understand broadly the concept of dual momentum. You're essentially mixing relative strength with trend following, isn't it? Now, I would love for you to elaborate on that. Let's break it down. Shall we? Let's talk about relative momentum to start with, and then we'll talk about absolute momentum, where you look back 12 months, and then finally the marriage of the two.
Well, first we have to understand what momentum is. Momentum means persistence in performance. And this was demonstrated back in 1937 through the first academic paper on it, showing that stocks that had performed well during the last year tended to perform better during the next year as well. So with relative momentum or relative strength momentum, you're comparing performance of one asset to another or to a group of assets, and you're going with whichever one has been stronger during your look-back period. And let's just use 1 year as an example. So let's say that we're taking the S&P 500 index, and I prefer to use indices for two reasons. First, the results have been better since 1800. Researchers have looked at applying momentum to everything: stocks, bonds, currencies, commodities, stock indices, and they found the stock indices work the best. And secondly, when you're dealing with stocks and momentum, you have very high transaction costs. And we're starting to get into scalability issues too, as more and more people jump into those markets with stocks. So let's take the S&P 500 as our primary index. Now, to have relative strength momentum, you need more than one asset. So the S&P 500 we'll use as our core holding. You can use the Sensex or anything else.
Right.
Let's take that as our core holding, and then let's take the rest of the world as our alternative asset. And there's exchange traded funds for both. So what we do is we say whichever of the two has been stronger during the past year will be the one that we'll invest in for the coming month.
Right.
And then the month after, we reevaluate it. And if the S&P 500 has still been the strongest over the past year, we stay with it. If now the all-world index becomes stronger, then we switch over. So it's like switching from a local train to an express train.
Right.
And you just keep doing that, and you end up with a substantially higher return, about the same risk profile.
Right.
But I show that from 1971 up to the present, if you just do that simple switch between U.S. stocks and non-U.S. stocks, you end up making an extra 300 basis points a year on average. Now, that's an enormous advantage.
Right.
The one problem with that is you don't get rid of your downside exposure. So you're still subject to behavioral biases and large bear market drawdown.
Right.
So in order to reduce that, what most people do is they diversify into something like bonds, fixed income.
Right.
And there's some issues associated with that. First of all, your return over the long run on bonds is substantially lower than on stocks. That hasn't been the case so much recently. We've been in a strong bull market in bonds up until a year or two ago. But historically, the excess return from stocks has been almost twice as high as from bonds. So that's one problem with doing a permanent allocation to fixed income. The other is that bonds have risk factors themselves.
Right.
And if you go back at rolling 10-year periods, you'll find that you've actually had more downside risk associated with intermediate-term bonds than you have associated with stocks, surprisingly. Right. And bonds can go into very long, extended bear markets.
Right.
So rather than be in bonds permanently and have a drag on performance,
right.
What I said was, well, when's the best time to be in bonds?
Right.
And the best time to be in bonds is when stocks are weak.
Right.
For two reasons. First of all, the Federal Reserve in this country notices that when stocks are weak, we tend to be going into a recession. And in recessions, they want to stimulate the economy, so they'll keep interest rates low, which is good for bond prices.
Right.
The other factor is when stocks are weak, people move their money or take their new money, and instead of putting it in the stock market when they see stocks are going down, they put it into bonds,
right.
Which again strengthens bonds at that time. So then I said, okay, well, how do we tell if stocks are strong or weak? And for that, we use the second form of momentum, which is called absolute or time series momentum,
right.
Where instead of comparing the performance of, say, U.S. stocks to some other market, like invested in stocks, we compare the performance of U.S. stocks to itself over time.
Right.
So if U.S. stock market has been up over the past 12 months, we say it has positive absolute momentum. If it's been down over the past year, we say that it has negative absolute momentum. Now, because momentum is persistence in performance, it works just as well with absolute as with relative momentum. And what that means is if stocks have been down over the past year, they tend to continue going down over the near term. So we will look at the S&P 500, its performance over the past year, and if it has gone up over the past year, we'll stay in stocks. And if it's gone down over the past year, we'll stand aside, and that's when we'll go into some low-risk form of bonds, like aggregate bonds, which have only about a 5-year duration, as our safe harbor.
Right.
Now, in order to combine the two together and to get dual momentum, what we say is, okay, let's look first at the S&P 500, because that tends to be our lead stock market indicator.
Right.
And if that's been down over the past year, then we want nothing to do with stocks, and we'll go into the bond market until we reevaluate next month.
Right.
If the S&P 500 has been positive over the past year and has positive absolute momentum, then we'll compare the performance of the S&P 500 index to the performance of the all-world index. And we'll go into whichever of those two has been stronger.
Right.
Okay. So, Guy, tell me one thing. So when you do this kind of stuff, you're taking 12 months as your time period. Any particular reason for taking 12 months, and does it work for shorter time frames if you reduce the time frames?
It does work for shorter time frames.
And how short?
3 months. Momentum is a phenomenon that researchers have found with stocks anyway,
right,
that works anywhere from 3 to 12 months.
Okay.
Now, the reason I picked 12 months are twofold. First of all, it works a little better with 12 months than for, say, 6 or 3, based on many different studies that if you go back long enough in time. The second is 12 months was discovered, you might say, in 1937 by two researchers back then, and it's held up well ever since then, going forward in time and going backwards in time. So rather than getting involved in trying to search for an optimal parameter, and there's always problems when you do that type of data mining or searching, I prefer to go with something that has shown that it works all the way back in 1937 and continues to work. Why not stay with it? Another added advantage to using 12 months rather than a shorter time frame is you have fewer signals, which means there are fewer whipsaws in and out of the market. I prefer to trade as infrequently as possible. If I could never trade, that would be ideal. But in order to be in tune with market forces, you have to trade a little bit. But I try to minimize that. Well, I think it was Warren Buffett who said, my profits come from sitting and not from trading.
Right. So, in this particular case, I just want to know that when you're using this 12 months time frame, there are a lot of questions about systematic trades on the indices, and there are a lot of people who claim to have, strategies for, let's say, 4 or 5 days in this, for example, swing traders and all that stuff. Have you gone back to test your strategies in these kind of scenarios? And so when I'm saying short term, I mean ultra short term. So where I'm coming from is that maybe the strategy works. Does it matter how much transaction cost come into picture and how much of return goes away because of the transaction cost in your model?
Well, transaction costs are a factor. They're not a major factor. From the dual momentum approach I just described to you, there's only 1.3 switches per year.
Okay.
And using just this relative strength momentum, there's less than 1 trade per year.
Right.
So transaction costs are minimal if you stay away from applying momentum to individual stocks.
Right.
If you apply it to stocks, it's a whole different story. Transaction costs can be very, very high.
Right.
But the big problem has to do with the nature of the markets and the time frame that you're using.
Okay.
Now, stocks tend to be trending, which means momentum works from a 3 to 12 month interval. But when you go out to 3 to 5 years, they become mean reverting. And that becomes the domain of value investing, where stocks that have been battered down over a long period of time tend to outperform after that. Okay. Now, the same thing applies to a very, very short window, say 1 month or less. Research has shown that stocks are mean reverting during that period as well. So if you're trying to use trend following during a very short interval, you're going to have problems. And before I realized that, before I knew that, I spent over a year locked in a room with TradeStation trying to look for day trading and swing trading strategies
Right.
over short time periods, and I
Right.
would come out to drink tea and eat my meals, and I was pretty much committed to that. And I would find some things that would fit the data beautifully, but none of them ever held up real time after that.
Interesting. Well, right. Gary, you mentioned in your research momentum adjusted for quality. The absolute momentum was adjusted to volatility. What does that mean?
I'm not sure what you're talking about.
So,
Adjusted for quality.
when I was going through your blog, it mentioned that when you're applying both the momentums to your strategy, relative strength and the trend following one, the absolute momentum, once you do that, the absolute momentum is adjusted for volatility. What does that mean? I didn't understand that part.
Uh, I don't adjust for volatility. There are some people who do,
Okay.
but my research has shown that it doesn't make much difference, and I try to keep things as simple as possible. Uh, Again, that's a very important principle. There are all kinds of people who try to make momentum complicated.
Right.
They'll try to incorporate correlations and volatility and many different assets, many of which don't have risk premiums that are as good as just stocks. So I think there's a tendency for people to want to overcomplicate things, to feel that they've contributed something to whatever model they're using, or to think that having things that are more complicated are somehow better.
Right.
And I've actually found the opposite is true. The more you can simplify something, the better it tends to be.
Right.
So, Gary, what stops people from, actively pursuing this strategy, or maybe just because it's a very new thing which you have introduced, maybe it'll take time. But do you have some kind of, let's say if you go and you talk to some fund manager, what kind of resistance you see towards this kind of a strategy, if at all?
Oh, there's many different resistances to this kind of strategy.
Right.
It's like, where would I start? I did a whole blog post on that about why momentum doesn't get the respect that it should have.
Right.
And part of it is, as you mentioned, unfamiliarity. People are reluctant to adopt something that they're not that familiar with or that they don't see a lot of other people use. So these are behavioral factors. People are affected by herding. If they don't see a lot of other people using it, then they figure, why should they use it? To go along with that, you also have risk of their career, because if they're doing something different and they underperform for a year or two, they'll get fired as an asset manager. And every strategy out there is going to have periods where it underperforms its benchmark. There's no way of getting around that.
Right.
So that's a significant factor. The other is prejudice, because people have been brought up at least when I was in business school, and I'm sure that still goes on, into believing first of all, in efficient markets. I think that's fallen by the wayside some. But they also believe that you can't get in and out of the markets, that you have to just buy and hold. The people who try to get in and out are being foolish. Now, that's true if you don't know what you're doing.
Right.
But research has shown that absolute momentum is just as powerful as relative momentum, and the research goes back just as far, if not farther. So I don't think that's true as much either. And the other factor has to do with the fact that momentum is so simple.
Right.
And people dismiss it. And there are reviews on my Amazon page for my book, in which I'd say, I get lots and lots of strong, positive 5-star reviews. My book, has a 5-star overall rating. But there's people out there who just, when they do have negative comments, very often it's because they think, well, this is so simple. How could it be any good?
Right. In fact, Gary, I wrote a small blog explaining how drawdowns eat into the overall CAGR in the very long run. But somehow, maybe because of Warren Buffett's influence, buy and hold has become a religion of sorts, and nobody's supposed to speak ill of it. I mean, do you think we need a role model on this side to bring about a paradigm shift in the way people think about this?
Well, you have some role models, but unfortunately they're not very systematic. Paul Tudor Jones is the best example I know of someone who's shown that you don't have to adhere to buy and hold.
Right.
And Jim Simons from Renaissance and Medallion, the same thing. They use tactical, systematic models for their trading, and they've done better than anyone ever has, even Warren Buffett.
But is there enough quality research available on their methodology or something like that? Because that in itself acts as a big deterrent to people taking this as a serious matter of study, so to speak.
There didn't used to be, but now there is. Just a couple of years ago, the first published paper came out on absolute momentum by Moskowitz and his friends. And then I had a paper also the same year, and that paper showed that absolute momentum is just as strong as relative momentum, if not stronger. And since then, there have been a number of other papers that have gone back and shown the same thing. And in fact, there's one study that goes all the way back to the year 1600, using trend following, something that's a form that's almost the same as absolute momentum.
Right.
And it's shown to outperform. So I think it's just a matter of time before people wake up to the fact that this is not just an idea. This is something that's actually been tested and has shown viability and persistence and consistency going back as far as you want to take it.
And in fact, Gary, to continue this, I have actually a skeptical question on that. Momentum investing with individual stocks is no longer a neglected strategy per se, because lot of interest is coming into it. But since it is no longer a virgin territory, would we lose alpha? I mean, look at what has happened to the returns of CTAs and mutual funds in United States. There's only a limited amount of honey, and more number of bees would probably screw it up for all of us, right?
Yes, that's a good question, Manish. I think what you say is true, and I think we're seeing that because in 2006 there were no publicly available momentum funds at all.
Right.
And now there's a dozen of them devoted to momentum with individual stocks, and another dozen at least multi-factor funds that use stock momentum. And studies have shown that these markets are limited in the amount of capacity they can take, because momentum stocks tend to have wider bid-ask spreads, and there's only so many of them that are effective. Studies have shown that momentum works best in concentrated portfolios where you might have 100 stocks or even fewer.
Right.
And it works best when there's reevaluation of the portfolio monthly or at least quarterly. So if you have 100 stocks, let's say, and you're going to turn over 25 or 30% of them, so you're trading in and out of, say, 30 of those stocks each quarter, and you have hundreds of billions of dollars all trying to do that at the same time, what do you think is going to happen?
Right.
Scalability becomes a big problem. And also transaction costs in general are a problem. There have been several studies showing that when you factor in transaction costs, your high momentum profits that appear in these research papers, most if not all of it disappears.
True. In fact, I was going through the FAQ of Ed Seykota, and obviously we all know that he has had 65% CAGR for good 14 years, but it seems the party's over as far as the CTAs is concerned, right? Those 14 years were from the 80s or the 90s, right? And so once too many people enter the fray, it's like they kill the party itself.
Well, that's true, but there's a number of aspects having to do with that. The first is, as you say, there are more and more people coming in and trying to exploit these same opportunities, and you have to have somebody on the other side, right? So you either need somebody who has an opposite view, right, and that's not very likely because most people in commodities are trend followers, or you have to have hedgers who right, come in and give up some return in order to reduce the risk of their portfolio. True. And there's only so many hedgers out there.
True.
Right. Gary, I have one question. So you have all these, you have studied most of the popular investors, and you said you've done a lot of research on this. Are there any other technical parameters or technical indicators which have helped, let's say, I'm asking you because Paul Tudor Jones has been very vocal in saying that 200-day moving average has been his way of exiting the markets. Do you see any other indicators which are used by popular investors and they have helped you in your research in generating more alpha or making timely exits besides your own model?
Well, let me clarify what Paul Tudor Jones said. He says he pays attention to that and he wants to be on the right side of it, but he doesn't use that for making his buy and sell decisions.
Okay.
I've watched him trade, right, and he's a phenomenal discretionary trader. He uses his mind is like a computer, and he synthesizes all kinds of information to make his decision. But he's unique in that respect.
Okay.
But the 200-day moving average is similar to a 12-month absolute momentum, except that it trades much more frequently because it's a little shorter time frame and it's using daily data. So it will keep you on the right side of the market, but you'll get whipsawed a lot using that. Right. So that's why I prefer absolute momentum. 10 or 12 month duration seems to make the most sense when you're dealing with the markets, the larger markets that I deal with. There are other indicators that may have some value. Some people pay attention to market breadth, the advanced decline line, and look for divergences there. I think based on the research I've done, I think there may be some information there that's can be useful to people. And you can look at other things like volume and there's just a whole slew of things, but it's very difficult to do research into these because what is the lack of data? You have price data now that goes back quite a bit, but not a lot of data for other factors.
True.
And also you have the whole problem of overfitting your data and making sure that what looked good in the past, that you have a reasonable expectation that it's going to do well in the future.
Yeah, true. So Gary, tell me, would this dual momentum strategy would also work in case of SIP, systematic investment plan, or dollar cost averaging?
Yes, my next to last blog post went into that, how it enhances systematic investing, and the two together make a nice combination.
Beautiful.
Gary, tell me one thing. The big reason of doing systematic investing is to avoid behavioral biases coming into, play. But doesn't following this strategy in itself very difficult to follow psychologically, because you will shift from an all stocks position to an all bond position instantly on the basis of the cuts? Do you think psychologically it's a difficult strategy to run?
For some people, that's true. Okay. And that's why you could just use relative strength if you want and not bother with going into fixed income, or just have some fixed income off to the side. Now, in my book, I talk about how conservative investors might just take, say, 30% of their investment portfolio and put it into fixed income, and then run dual momentum on the rest of their portfolio, so that they always have some kind of fixed amount. And you can find whatever percentage that you're comfortable with. But if you're going to participate in the equity markets, you would be better off using both forms of momentum from an economic point of view.
Okay, and can you tell me one thing? How does the return portfolio and the risk-adjusted return changes if you go from long only to long short kind of strategy, where you start shorting the markets when it is asking you to go into bonds? So, have you done that, and how does it changes the strategy?
It's not as good as going into bonds. You would think that it might be better, but the problem is the markets have a natural upward drift to them. And because what we're doing is a slower moving strategy, by the time we get out and then get back in, and when we're out, we go short and then get back in, not too long from then, we would do actually a little bit better in bonds.
Okay.
So if you had a shorter term approach, I think going short would make more sense. But because we're long-term oriented, and because of what I mentioned earlier, that when stocks are weak, bonds tend to do their best, I think that that helps in terms of being in bonds when we're in bonds.
So Gary, if I'm understanding the strategy correctly, would I be correct in saying that at this time now this strategy would be underperforming S&P? Am I correct?
It depends what time frame you're looking at. If you're looking at just since this bull market began, yes, that's correct. But you really have to look at a full market cycle to determine if how well this performance really is, and preferably more than one market cycle.
Yeah, definitely. Yeah, I just wanted to understand if I'm picking up the nuances right. Because if it's a drawdown, the whole edge of the strategy is that it saves you from the drawdown, right?
That's not the whole edge. What happens is that because of relative strength momentum, you also earn some very attractive returns just from switching from U.S. to non-U.S. stocks.
Right.
And if you were to look at just bull markets and forget about bear markets, if you were only to use absolute momentum, you would underperform,
right?
Say the U.S. stock market. But by using both together, relative momentum applied to U.S. and non-U.S. stocks, you actually outperform buy and hold, even in bull markets, if you have the patience to let it work for you. Now, over the past 7 or 8 years, the U.S. market has been stronger than non-U.S. stocks, so we haven't had an opportunity for that to come in and enhance our return during this time. That's why I say over the long run, this will work in your favor. The other thing you should understand is that this strategy of dual momentum does not get rid of short-term volatility.
Right.
And people need to realize that because, in fact, I got an email just the other day saying, well, I've been doing this for 6 months and I'm underperforming. I'm not making as much money, so what's going on? And I say, well, what's going on is what's always going on. Take a look at the month-by-month returns. It's on my website, and you can see there are periods where it underperforms. This is a long-term approach, and you have to be willing to accept short-term volatility. That's how we make our money. That's right. How you can't get rid of volatility and expect to make extraordinary profits.
Right.
So we really should be embracing that volatility, and even if it means that occasionally there are 10 or even 15% drawdowns, right, because that's what's going to give us the high returns over the long run. We can be confident, though, if the future is anything like the past, that we're not going to have to suffer through these horrendous, 40 or 50% drawdowns like most buy and hold investors are who hold on stocks.
Gary, having your backtest, have you considered valuation-based exits in the markets or in stocks?
I've not looked just at exits. I've looked at valuation timing.
Okay.
And momentum is so strong that it dominates anything like that. There's no reason to incorporate something like that. The same thing with stops. Stops can be useful if you have nothing else.
Right.
But when you already have a risk management framework like absolute or dual momentum, they're worse than redundant. They actually detract rather than enhance.
Okay. So you have used S&P, ACWI, and bonds for your strategy. I was just curious to figure out if its application in India. I mean, how do you shortlist an asset class? We have Nifty for S&P, all right. We have bonds, but ACWI, we don't have any ETF taking care of the international markets, right, Puneet?
Yeah, yeah.
And you've also ruled out commodity and currency. Am I correct, Gary?
Yes, but what you could do is you could use the Nifty against the U.S. S&P and use relative strength for those. All you need are two things that are going to move differently to one another. And the fact that you're in India, you should use one of your markets there.
Right. Gary, one question which I have in this regard is your whole premise lies in finding asset classes which are, let's say, not very highly correlated, right? So don't you think the correlation in itself is a very dicey number, in the sense that when the market falls happens, most of the things which are uncorrelated, they become correlated, and on the bull side that's not the case. Do you think that is the right way of looking at it?
Well, that's true when you're talking about the relative momentum side of things, although I think the Nifty and Gold B, I mean, that's not going to be correlated. So that was a good choice. In fact, I was thinking of that because when I was in India, that's correct. Those were the two things that I saw that were quite liquid there. But when you're talking about moving into a safe harbor like shorter term bonds,
right.
I don't think you're going to have that problem because people are looking for safe harbors when everything goes down.
Right.
So if and that's why I don't use long-term bonds, because long-term bonds also have risk, and when there's a flight to safety, people want to get out of all risky assets.
Right.
So I prefer using shorter-term bonds as my safe harbor, and usually you're out before these types of panics occur. You don't get out at the very top or in at the very bottom, but when you have the very uncomfortable moves down, you're already in a bear market, and by then we're safely in short-term bonds by that time.
True. That's true for any good trend following system, isn't it?
It should be if you're not too short-term oriented, and that's why I prefer to take a longer-term approach to things.
Right.
Right. Anything else, Manish? From my end, I have asked all the questions I have for Gary.
One last question. I'm just thinking out loud. Since gold and Nifty is something I've done, would it also make sense to probably have a uncorrelated relationship between USD INR and Nifty? Because invariably they move in opposite directions too.
Yes, I would actually prefer that to gold because gold tends to languish for long periods of time.
Right.
And the real outperformance in gold just came in the 1970s when it was catching up.
True.
Because it was under pressure so much. So you could use all three. There's no reason you have to limit to two. But I would prefer to use the Nifty with the U.S.
S&P.
Yes.
And do you also take sectoral indices into consideration?
I have a model for that, a sector rotation model. But here's an interesting point too, is when I developed my sector rotation model, I only had data back to the early 1990s.
Right.
But since then, I was able to get data back to the 1970s, early 70s.
Right.
And when I did, I could see that the model wasn't as robust as one without sectors. And the reason is because sectors tend to be too volatile. And a longer-term model like I have would, by the time we would get out of sectors, sometimes too much of the profits would be given back. And that's why something like gold could be a problem too, because it has extreme volatility at times.
Right.
So what I found was that the broader-based market averages tend to do better, and that's what I stay with now.
Right, got it. Gary, that's it from my side.
Gary, thanks a lot. It was a pleasure talking to you. And and you're as fascinating as a character as the forward from Wesley Gray made me think. So before the podcast, I was telling Manish that it's going to be a very fun conversation, and I think I was not wrong. What about that, Manish?
बिल्कुल सही. बहुत मजा आया.
Right. Thanks a lot, Gary. Thank you so much.
Thanks, Gary. Take care.
You too.
Yeah.
You too. फिर मिलेंगे.
Yeah, definitely. फिर मिलेंगे.
Okay.